Hello everyone and welcome to another market snapshot with me, Craig Erlam, Senior Market Analyst at OANDA. Now let's start once again with a look at today's economic calendar. As you can see, very full today with the release of these services PMIs throughout Europe and the US. There's also been a couple of other notable events which we will touch on throughout the video. The services PMI themselves have been a little bit mixed from a Eurozone perspective. 52.6 for the composite PMI, 52.2 for the services PMI. On the one hand, it is good that the Euro area is actually seeing some growth expectancy here. On the other hand, this is still relatively weak growth and is consistent with the kind of levels that we have seen of just around 1% growth per year. So nothing to get too carried away with. The German services PMI, again, be at 50.9 is a little bit of a concern here. On the other hand, the manufacturing PMI was better earlier in the week, and the rest of the data which we've had from Germany, which at the end of the day is the main engine of growth for the Euro area, has been mostly good. The GDP figures for the second quarter, for example, were very good. So I don't think there's necessarily anything to be concerned by here. Germany just repeatedly being dragged down from a sentiment perspective by the slowdown which we had in China, which has rebounded on the back of some big fiscal stimulus efforts from the Chinese government. It was dragged down again by the Brexit vote having the closest ties to the UK, and therefore I guess having the most risk exposure to Brexit. Obviously the UK also being a key ally of Germany in the Euro in the EU also had a detrimental impact as well. The French PMI readings are looking a little bit better at the moment, but again, what we consistently see with France is stuttering growth and stagnation. So I think we need to see a lot more hard data from France before anyone starts to believe for a second that we've moved through this period of stagnation for the French economy, and we've moved through this period of very slow economic reforms and low levels of economic growth. In terms of the US, we've had a lot of data out already today. The ADP employment change obviously stands out as a key release ahead of Friday's non-farm payrolls. That was 154,000, slightly short of expectations and a slight revision to last month's reading, but all in all, it's not something like 154,000 isn't going to get the markets too excited one way or another. I truly believe right now that we're in a phase, especially with the December meeting 2 months away, given that the November meeting is somewhat appears off the table right now because of the coming a week before the US election. Anything less than 200,000 or above 100,000, I think, is going to be largely ignored by the markets. That doesn't mean we're not going to see volatility around the event. More often than not, we will see a lot of volatility around. But in terms of what the markets are actually going to grip onto, I think they want to see something either extremely good or extremely bad. And given that expectations for December are now relatively high by market standards at above 60%, I think a very poor number is likely to have a much bigger impact than a very good number. The services PMI reading again was better than expected, but nothing to be getting too carried away with. Again, consistent with the lower levels of growth which we've been seeing from the US. The composite the non-manufacturing PMI actually was very good, and it is the non-manufacturing that people tend to pay a little bit more attention to. So the fact that that came in at 57.1 is very strong from a US perspective. The figure that's had probably a bigger impact today, and that's especially following last night's API reading, is the Eia Crude Oil Inventory number. And again, we'll touch on that when I bring up a couple of charts for you guys in a sec. But a fifth consecutive drawdown here is quite bullish for oil prices, and coming on the back of that flimsy OPEC deal, which the markets have got a little bit excited about. Oil is looking a little bit bullish at the minute, even if it potentially is getting to that overheated stage, given that we have had so many consecutive sessions of oil price gains on the back of the deal, the apparent deal between OPEC members. A couple of other stories to touch on today. You'll have seen on the economic calendar that Fed's Charles Evans spoke overnight. He said he was fine with a rate hike in December, and believes it's not the timing of the next rate hike that's important, it's the path of future rate hikes. This is important with Charles Evans because despite not being a voting member of the FOMC now, he is a voting of the FOMC in 2017, as is Neil Kashkari, who's also speaking today, although we haven't had anything noteworthy come from his speech yet. Jeffrey Lacker said he would have dissented at the September meeting had he been one of the voting members. So again, another hawkish comment to go with the hawkish commentary which we have had, it would appear, recently from Fed officials. The biggest story today, the one that's had the real impact in the markets more so than anything else though, has been these reports earlier in the session about the ECB. Now these reports suggested that the ECB was contemplating tapering, and they were discussing what the method of exit would be, and the reports that we had from Bloomberg, it was suggested that they were discussing they were discussing tapering in 10 billion euro amounts from the 80 billion that it's at now, of course, until it gets to zero. Now, the reason that this had such a big impact is not because markets necessarily believe, or people necessarily believe, that tapering is going to begin in March 2017. I think most people still believe we are going to see an extension of the program in March at this stage, and it is worth noting that a spokesperson denied these reports that tapering had begun. But I guess they always have to begin somewhere. There's no smoke without fire, as they say. And this just does appear to be one of those things that the ECB is potentially discussing at the moment, this exit strategy, but not necessarily for the near term. I guess coming at a time when people are disputing whether there is enough assets available for the ECB to purchase, and therefore whether they can extend beyond March, or whether they have to adapt their program, and whether they're able to. Maybe this is why the story's gained so much traction. What we've effectively seen today is a mini taper tantrum. Now, for those of you who remember back in 2013 when Ben Bernanke, Fed chair at the time, first mentioned the idea of tapering asset purchases, that's beginning the program of reducing the number of asset purchases. There was a big shock in the markets, which was called taper tantrum at the time, when we saw US Treasury yields rising, we saw the dollar rising, and equity markets came under a little bit of pressure. We have seen yields in the euro area rising during today's session by varying amounts. Spain and Italy seem to be taking the brunt of it, but also things like German and French yields also on the rise as well. And this seems to be linked to these reports, like I say, despite a spokesperson denying the reports. It's going to be very interesting now at the next meeting to see exactly what the ECB do say on this matter, whether they bring it up themselves or whether they are questioned on it. Now, let's take a look at a couple of charts, because, like I say, it has been a really interesting day for a really interesting week, for the markets. We've seen some very significant moves. The FTSE remains at around those record highs. The record highs around that 71.23 level. We touched that yesterday, or came close to it, before pulling back. Now we are seeing that pair those gains today. I'd be surprised if we didn't see that come under pressure again in the next few days. So there's been no further developments in this case. In terms of oil, if we look at Brent Crude, we have seen it push now through here to the 3-month highs here, hitting around this 51.50, running into a little bit of resistance at this stage. This came off of last night's API number. I touched on it a second ago. Today, the Eia Crude Oil Inventories came in to show 3 million drawdown. It was more than expected, because we were expecting a small build, or a similar size build, but it was also the 5th consecutive drawdown, which is bullish for crude, which again, coming at a time when the OPEC deal has announced, really has helped crude lift off. It'll be very interesting to see if we can go through that 52.40 level, or whether we see some profit taking at those previous highs. But it was last night's API that really triggered this. That came in, that showed a 7 million, I think it was a 7 million drawdown in crude oil stocks, and that really got the ball rolling today. With a 7.6 million drawdown, and that really got the ball rolling today with these gains in crude. And I think the EIA number, while being short of the API number, really has just helped build on these moves in Brent crude. But like I say, 52.40 I think is a big level next. I really wouldn't be surprised. Personally, wouldn't be surprised if we see some profit taken at that level. At which point, the 51.08 does become a notable support zone here. In terms of gold, we've not seen any real movement today. We saw a bit of a dead cat bounce earlier on, around the 61.8 fib, around 1266. We also have that support zone, support and resistance zone here, which could be key. But this dead cat bounce, which is effectively when we see a bit of profit taking, but it doesn't have the legs to make any significant strides in the opposite direction, is typically quite bearish. And I think the next big level here is 1250, those previous lows, and this is where those two moving averages start to come into play. That's the 200 and 240 period moving averages. The other area where we've seen some real big progress today has been dollar yen. You'll remember I touched on this yesterday. We had that 103 to 103.20 area, which is very key because we had the 89 period simple moving average on the daily chart and the top of the Ichimoku chart. If we see a breakthrough that top of that Ichimoku chart and a daily close above, it could be a very bullish signal. You can see that the Ichimoku chart on many an occasion during the downturn has provided adequate resistance. Now, what made this one look a little different was that the run up to the top of this Ichimoku chart was very, very strong by comparison to the recent tests of it, and I think that it's that momentum that's really helped to drive it through. So if we can see a daily close above here, then I think that would be quite a bullish signal, at which point in the near term you could be looking at these 104.30s or 105.50s, but I think this 107.50 could be a very realistic level for this pair, should we again see a daily close above that Ichimoku cloud. So again, the charts are looking so interesting right now. It was a bit of a slow summer, and it did take a while to get going, but since the summer we have seen the charts looking much more interesting, and I think the next few months are going to be a very interesting period for the markets. For more in-depth news and analysis, check out OANDA MarketPulse at MarketPulse.com. You can also find out more about OANDA and sign up for a free demo account at OANDA.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.